What?
Share that. That's what we get that.
Hey Cheryl, how's it going?
Great. How about you?
Great, thank you. Great seeing you.
Yeah, you too. It always makes me jealous. You're always so tan.
Ha, that's Arizona for you.
I know. I was a sun worshiper in my younger days, and
Well, when
now
I'm
I don't get
out there, you can have the last lap.
Oh my goodness. Where is everybody? My goodness.
That's what I'd like to know. You got the email, right?
Yeah.
I just resent it because Jeff's popping on now, but Jeff called me and said he got the email and then all of a sudden it disappeared. So
Oh,
I don't know if that's a Gmail thing or what, but we'll give everybody a few. Oh, there's Steve Wilson. Okay, people are getting the,
hi, Jeff.
Hi, how's it going?
Great. How are you doing today, Jeff?
Doing really good. Doing
You
really
guys-
well.
You both had a great weekend?
absolutely.
How about you
Nice.
guys?
Nice. Great
Very
weekend.
relaxing. Got to just spend time with the kids and put work away at least Sunday and
Oh.
most of Saturday.
Oh, that is
That's great,
so
Mark.
awesome.
That's awesome. That is.
Mhm. Yep. I
You know, and
know.
it wasn't age appropriate, but I was thrilled to take them. The Godfather had a 50th year
I
anniversary
saw that.
at AMC.
I saw that.
Incredible.
Was it cool?
I loved it. I took the kids.
Yeah,
12-year-old said it was a little slow, but the 14-year-old loved it. So
that's cool.
3 hours, you can't blame him.
Yeah.
Oh my gosh, I can't believe that you took your kids to that.
I can't either. You know, it's funny though, Cheryl, by today's standards, that rated R film is probably a PG these days.
Okay.
Oh, probably, huh?
Yeah,
Just a little bit of killing.
yeah.
Well, I came in at the right time.
Yeah.
Yeah, you did. Hi, Betsy.
Yeah, you better be
Hey,
getting
guys.
that.
PG,
Hey, Betsy.
oh my goodness. Hey, Jeff.
No, we were just talking about the Godfather had a 50th year anniversary screening at AMC last week. It was pretty great.
Oh, okay, cool.
So again, we'll let people file in. It just turned 1 o'clock. So and Jeff, maybe everybody had that issue you had. So I did resend the email to all.
Yeah. It was so weird. I saw it pop up on my computer. I literally unplugged my computer. Mike has a one too. So I walked in the conference room and email was gone. The
Yeah, that
weirdest damn
might
thing.
have happened to everybody. So I resent it to all and we'll give everybody a minute or two to clock in.
So did we left off last week with the presentation, right?
We did the,
Perfect.
yeah, because we did the illustrations last week.
Illustration and presentation last week.
Yeah.
Yep. So this week we'll do objections.
Yes, that's what we were. No, wait,
Yeah.
last week we did
You
objections.
did objections
We
last
did
week.
objections last week. All right. Well, then
Yeah.
this week we'll do it. Advanced mechanics.
Love
Got me
it.
switching
Yeah, that's what
gears
you were
here.
gonna get into this week. That's right.
Yeah.
Yeah.
Yeah. Let's do advanced mechanics. That's a good one.
Advanced mechanics.
Yeah. So this one, guys, is not going to be. That's not what I want. It's not going to be client focused. What we're going to go over today is just 99% of it's for you guys. I see Dominic shaking his head like, all right, I like it, Betsy. I like it. So this is going to be for you guys. This is, and I'll give you guys this disclaimer before everybody gets on, but there was a period in my career, it almost got me out of the business, where I just wanted to go into people's homes and just throw up on them and tell them how smart I was and how much I knew about IULs. And that translated into this many sales. Okay. 0 sales. And I tell this story. It's funny. It's a little bit funny. If you know me, it's not that funny, but if you don't know me, it's kind of funny. And it's funny because it's true. I was sitting in Reno, Nevada, watching March Madness. So I probably had a beer 4. And I saw, it was either Prudential, Nationwide, some commercial. I don't know if you guys remember, but the agent is outside in the bushes and the clients inside are talking about the retirement and what's going on. And they were scared, and they were scared about 4 things, right? They were scared about one of them dying. They were scared about losing money in the market. They were scared about taxes going up, and they were scared about running out of retirement money. And I went, oh, they're talking about an IUL. And I literally wrote the 4 things that the IUL does in the presentation that's all built around on the back of a napkin at a bar. And
Wow.
that's literally how I came up with the 4 things, which is now the 5 things because I put DFL in there. But yeah, but that's seriously, that's how I got back on track as an agent to say, hey, I have to focus my presentation, because if I go in there and tell them, how much I know about IULs, they don't care, right? If you went into somebody's house and started quoting Nelson Nash's book, they don't care, right? On infinite banking, they don't care. You have to keep these presentations simple, very pedestrian, very, very basic. And this today is for you guys to give you guys the confidence and conviction. Because I used to sell IULs all the time, but I'm like, how's the money there? Like, how do these things really work, like under the hood? So for a client, we're gonna teach them how to tell time. We're not gonna tell them how the watch works. Today I'm gonna teach you guys how the watch actually works. Okay?
Yeah. Yeah.
Okay.
Love
Any
it.
questions?
Jeff?
Any
Right.
questions before we get rolling? No questions?
Nope.
All right. Let me
You
share
mean
my
like
screen.
pertaining to what we're about to talk to, just like in the past and what you covered already?
Anything, buddy. They pay me for all the questions. So
Yeah, there's one question I do have. So
yeah,
when
go
you're
ahead.
when you're creating an IUL and you're switching from the B to A,
Yes, sir.
do you turn that off the year before they start withdrawing, or should you keep that on, or should you keep that on there?
You should never do option B, increasing in perpetuity. And the reason being is because if we keep it increasing forever, the cost of insurance will increase forever. So we change back to level when we stop paying.
Okay.
Okay. So as soon as we stop paying, we want to level out that premium, or we want to level out that death benefit so the cost doesn't keep going up even higher. That makes sense?
Okay. Yeah.
I just saw your Notre Dame shirt. I'm sorry. I think you got something on there. Drop something on
I think it's fine.
there. All right. So here we go. You guys see my screen? Advanced mechanics. Anybody have anything else? Hey, Mohammed. What's up, buddy? I'm getting to see you around the tour, huh? All the trading tour. All right. So today's trading outline, we're going to break it down into those 4 categories. We're going to talk about how an IUL protects your family and protects your income with the 7702 guidelines. We're going to talk about what a target is, what a MEC is, and what the policy minimums are. How it protects you from market risk. We're going to explain a cap and floor to you, annual lock and reset, historical backcasts and what those mean. We're going to talk about volatility control indices for those of you out there selling annuities, the Barclays index, and our industry is going to be all volatility control indexes real soon. Maybe not for par whole life, but for IULs and annuities, volatility control indexes they're everywhere and they're not going away. We're going to talk about how interest rates affect caps and affect loan rates and why that's important in an IUL. We're going to talk about how it protects you from unnecessary taxes, a loan provision, what a withdrawal is, what a loan is. We're going to talk about the net dollars at risk and the cost of insurance. And then we're going to talk about the overloan protection, why it's important to have a high cap or high interest rates and then a capped loan rate. And then we're going to tell you guys how the insurance company makes money. Okay. None of this, maybe with the exception of cap and floor and annual lock and reset, and maybe the volatility control index, this little section over here, this little section right here. Nope. Is probably the only thing I talk to a client about. The rest, keep it to the presentation. Okay. Section 7702 of the IRS code. Has anybody ever read it?
No.
My nerdy self has. It'll put you to sleep. But it gives us the definitions of what life insurance is, okay? How it's taxed, how it's not taxed, okay? So it literally defines how much money and what is considered a life insurance contract and what's not, okay? It defines the acceptable death benefits and cash value levels. So a participating whole life is designed where the cash value has to meet the death benefit at age 120 or 121. IUL is not like that. IUL has certain quarters for this age person and this much death benefit or net death benefit. You're only allowed so much cash in there. And that's why the death benefit, if you guys have gotten your statements on clients, that's why the death benefit changes a little bit different than what you illustrated based on what returns that client got over the year. Okay, they're keeping them within that corridor of minimum death benefit and maximum cash value. Does that make sense? Okay, I talked about the corridors. Sometimes they call them silos, but they keep it in line. Okay, who wants to tell me what a modified endowment contract is?
Something that you don't want to use on an IUL.
Well, you know, there are a couple. Shelly, there are actually a couple. I've seen a couple products where it's okay to mech in an IUL. It's really a tax-free annuity alternative. It's like a single premium IUL, where it would be they'd pay taxes on the gains anyway, like in an annuity. But how is a mech defined? You're right, it's not good in an IUL, but how do you define it?
You just what you just said is taxed. It's taxable on the gains.
What makes it taxable?
Isn't when the cash value exceeds the death benefit.
Well, you
Or
can't have the cash value exceed the death benefit. You can have it exceed the net death benefit, but you're not allowed to have it exceed the death benefit. So you're getting close.
I think a mech, I mean, it's basically set up so we don't dump in too much money at once or over a period of time and allow for that to basically be too, lack of a better term, supercharged. I guess can't take a bunch of money and dump it into a life insurance
Yeah.
policy. It's
Yeah, they define how much money, and I'm gonna use this because it's here. If this is your life insurance contract, okay, the federal government says if that's all the cash you're allowed to put in here. Okay,
Yeah.
if you put one more drop of water in this bottle, you need to get a bigger bottle and you need to have more death benefit. So what it is it's when the cash value exceeds the corridors or what's acceptable inside of a life contract. It says, nope, the federal government smacks you on the hand and says, no longer a life insurance policy. Now you got an investment.
Investment, exactly. Yeah. Mhm.
Okay, so that's what a modified endowment contract is. Okay, this is worded much better than what I said, but you can see it's when a life insurance policy is morphed into an investment. Okay, too much premium stops being a life insurance, or stops being life insurance, starts being an investment. Who can tell me what target premium is?
That's where you know how much you want to have in that account. And you need to figure out how much you have to put in there in order to get to that target price. No,
Kind of, yeah. You're explaining how
Yeah.
you find target, but what actually is the target?
It's the
Is it basically
required
life
premium,
insurance?
the required premium payment.
Kind of. It's that midpoint. It's that if you just say, hey, let's solve for target, it's the midpoint between a max funded policy and a minimum policy. You can move the target, okay, based on how you set it up. And if you set it up anything other than minimum death benefit, maximum cash value, I'm gonna make fun of you or not have your back when it all hits the proverbial fan, right? But the target premium is just that midpoint of where it falls between completely max funded and minimum funded. Okay, it's really simple. Who can tell me what the policy minimum is?
The amount of money to
Oh.
keep the policy in force.
Yeah, real simple. It's the minimum amount of premium to keep that thing rolling. Okay. So targets can change, but it's that midpoint between a max funded and a minimum, and you can adjust that. And the policy minimum is just to keep it rolling. Okay. So moving on, protect you from market risk. Who can explain to me what a cap and a floor is?
A cap, you can only put so much in, and the floor, you don't lose anything. You have a bottom. You
You're
can lose
100%
something, but you stop at a certain point. There's no, you can't go
Well,
beneath that floor.
Okay, you're kind of right on the floor. You can't lose money in an IUL, at least in an IUL you can't. In a VUL you can. In an IUL you can't lose money. So a floor is the absolute minimum that contract interest rate, the minimum. But what's the cap? It's not a cap on how much you can put in.
Oh,
But
Go ahead,
it's
Cap on how much
I'm
the
muted.
insurance company will.
Hold on, ladies first. Go ahead, Betsy.
Yes, I'm sorry.
no, that's fine.
Okay.
The cap is the highest interest rate that the insurance company will provide on that. Like
Yeah.
that.
So right now, I think the cap with F&G is 13. So yeah. So you can't get any more interest than that 13% in the back of my office. Nice. Okay. Now, let me go back. Ooh. Hold on. I'm going to go back a little bit. Go back.
If I have a question while you're doing that real
Yes,
quick,
sir.
if I may.
Yes, sir.
Did F&G recently change the caps on the Barclays Trailblazer? I believe at one point that was uncapped. Was that recently capped?
It's still uncapped. They
Okay.
just changed. There's some things going on there. I'm gonna change. Come on.
Is it the participation that got changed or what?
Yeah, the participation rate changed. All right. So we're gonna go animations, slideshow from current slide. Okay. I knew that was going to happen, so that's why we had to do that. Okay, if you guys see my screen, it's pretty clean.
yeah.
All right. So now we know the cap is the maximum interest rate you can get, and let's just say it's 13%, and the floor with F&G's pass setter is 0.25. I'm going to ask you guys a question. It's a little bit of a curveball. Okay, there could be an adult beverage for somebody who gets this right. Okay. So if the cap is 13, and let's say the S&P 500 for the year does 15, what happens to the other 2 percentage points?
Goes to the insurance company.
All right, who said that?
I did, Dominic.
Dominic, you are incorrect.
Ah,
I
What
have no
happens-
idea, but I assume it goes into some fund in case of future issues, like a security.
You are incorrect. That's why I was offering adult beverages for anybody who got it right. There is no other 2%. There is. It's a trick question. That's why I said it was a curveball. Okay. It's an option strategy. So what happens is when you pay your premium into an IUL, the over and above the cost of insurance, over and above the fees, which that altogether is called the cost per thousand, that money goes into bonds. Okay. Those, who knows how much bonds produce after like a treasury bill, US Treasury bond. How much interest do they accumulate?
I have no idea.
About 2%?
No, well, how about between 4 and 5%? Okay. For you par whole life people, where do you think they get the guarantees that we're not allowed to say anymore at 4%? They get them from bonds. Okay. So all a par whole life company does is take your extra premiums, the PUA amount, put it into bonds, turns around and gives you the proceeds. That's all they're doing. And IUL does the same thing, except they take those bond proceeds and now they're buying an option. Okay. Now they're going to Barclays Bank and saying, hey, this is how much I got. Okay. What can I buy with this amount of money? And they say, oh, you can buy a cap of 13 on the S&P and a floor of 0.25. So if the market does anywhere between 0.25 and 13, your client gets that growth. If it goes above, it doesn't matter. We only bought that space. That's the only space we're allowed to participate in is 0.25 to 13. If it does something different, doesn't matter. We only bought that space. Does that make sense to you guys?
Yeah. Mhm.
Oh,
Okay.
Yeah.
Yeah.
well, that
So
kind of
it's so-
sucks in a way.
Well, not really.
If
I
it-
mean, it's actually
mean,
pretty
if
good.
it-
I mean,
If it goes above that, you're not getting that extra, right?
yeah, but if it goes
But if
below,
it goes down, you're not losing anything.
you're not losing anything.
So,
Okay.
Okay.
yeah.
And I can go back to here and show you guys this. I can show you guys this. Have you guys seen this one? Did I show you this one? Okay. This is how important having downside protection is. If you lose 40%, okay, you got to make 67% just to get back to even. You with me? Who wants to play a
Mhm.
game with me? Who wants to be a client and play a game with
Betsy
can.
will.
Yeah.
I
Cheryl,
volunteer
okay.
Betsy.
me? Betsy, Mohammed, you want to do? I'm not. We can't volunteer anybody else. Mohammed,
Sure.
you wanna play?
Yeah, sure.
Okay. So Mohammed, you're going to be in the market, and I'm going to be in the index, so I don't lose. Okay. So
Okay.
let's say we both have 100 grand. With
Mhm.
me?
Yeah.
The first year the market goes down by 10%. What do you have?
90%. I mean, $90,000.
$90,000. What do I still have?
You still have the same amount you had, 100,000.
100 grand. Next
Yeah.
year the market goes up 10%. What do I have?
110.
What do you have?
I have only 10% of 90,000. About
what
that
is
would
that?
be 91,000.
Go grab your license. What's your social security number? Welcome to index.
Yeah. Mhm.
Okay. Because you're not even back to where you were. That's
No.
the power of having
Mhm.
downside protection.
Yeah.
Okay.
Mhm.
All right. Get back to it.
Yeah, that's good stuff right there.
Yeah.
Okay. Who wants to tell me what annual lock and reset is?
Let's see.
Anybody want to tell me what annual lock and reset means? Every year, annually, your gains are locked in. We reset. We play the accounting game again. We do the account. So it's a point to point, a yearly point to point is what annual lock and reset means. So the client should understand a cap and floor. They should understand annual lock and reset. Okay. Every year your gains are locked in. They cannot be taken away. We reset and do the math again. Okay.
So that's where the compounding interest comes in.
That's correct. Yeah, and you're compounding because you can never lose. So you never have to get out of that hole. Now I did this slideshow a while ago, but on the F&G illustration, you have this number. That number, that non-guaranteed assumption is based on a 65-year look back at the S&P with that cap and floor, with the ups and the downs. You think we've been in some ups and downs in the last 65 years?
Yes.
So AG 49 is the actuarial guideline that dictates how our illustrations are run. And it says we have to illustrate with a 65-year look back. Okay. And that's where that number comes from. So it's not really based on 10-year, 20-year, right? It's based on a 65-year look back with those rules.
Hey, Jeff, can I ask a question?
Yeah, of course.
So whenever I call a carrier and
Mhm.
I ask them for this particular portfolio, whether it's Barclays or some other one,
Mhm.
what is it currently earning? They can never give me a straight answer. So I'm not sure if I'm asking the right question because they always give me that illustrated amount, which I know is not correct.
Yeah, well, you got to give them a period of time, right? So great question, great time. So right here, this was based last year. Okay, the cap was 13.5. I didn't update my slides currently, but the cap was 13.5. Okay, If you had these rules, the 10-year average for the S&P 500 was 11.16. We did great, 8.94. But if you look at the 20-year average, it only did 4.16 because we had the .com bubble. We had 2008. We had to climb out of those holes. Our clients did pretty darn good at 3.37. Now this number right now, the 10 and the 20 is really high because we're starting here moving forward. We've been in a historical run the last 10 years, right? The 10-year average is up to like 14%. How long do you think that's going to be around? It might have actually gone away today. I haven't checked the market yet, but it might be on the way down. Okay. Our clients are going to stay within this range because we don't lose. We don't have to pull out of these .com bubbles, the housing prices. Okay.
Okay. So really, when I ask them that question, they just don't have that data yet. As
We
far
don't know.
as
We don't know. You want to go back to the last 10 years? It did 8.94% on this index. You want to go back 20 years? It did 7.37. How's it performing right now? We don't know yet.
okay.
But good question.
Oh,
So who does anybody know how a volatility control index works? So the Barclays, the NCAP strategy we were talking about, this is how it works. Okay. There's 3 buckets of money that your premium goes into. Okay. Cash, US dollars, bonds, US Treasury bills, and markets. And right now, F&G and Barclays has 6 sectors of the market: precious metals, real estate, travel, health and science, and there's one more. There's one more, and I forget what it is. But what happens is the money typically comes in and goes to bonds. When those bonds are matured, they go to cash, then they like these sectors of the markets, and markets are bad. We got to go to bonds. More money comes in, go to cash because markets are down, and they rebalance based on computer algorithms every single day. Okay. Now, what it looks like to somebody, it looks like this. Okay. So this is a normal market chart, right? You guys have all seen that.
it's like right now the market is down over 600 points.
Yeah. Okay. Now, what a volatility control index does, if it's a 5%, it lives in this little 5% window. And it'll follow the trends of the market. Okay. But you'll never find yourself, it might go like that a little bit, up a little bit.
Right?
Yeah, you'll never find yourself on these big undulations up here or down here. You're going to be in this, you're going to follow kind of the path, but you're never going to spike up or down. Now, who remembers what happened to the markets after Trump took office? You guys remember?
After what?
Trump took office.
They went
They
up.
skyrocketed up because
Yeah.
deregulation, everything, right?
Mhm.
But if you guys remember, there was a pause. The markets
2018.
paused.
Yeah.
Yeah, they paused. And the reason they paused is because of all these international banks have these volatility control. Well, this is volatile. If it goes up real fast, real short, they all went, that's volatility. We're gonna pause. Okay. So I know F&G has written into their algorithm some geopolitical stuff, which is probably pertinent today, but to account for things like that. So that's really how the volatility control index works. Okay. So it eliminates the big undulations of waves up and down. And here's a good question, and we'll move on to the next one. How do interest rates affect the cap? So interest rates right now this year are going to have to go which way? They're scheduled to go which way? Up. Yep, scheduled to go up. What's that going to do to our clients' caps on the S&P 500? Who knows what's going to happen? You got a 50-50 choice on this one. They're going to go up or down.
No.
Nobody wants to take that one?
Okay, I'm gonna guess. I don't know for sure, but I'm gonna guess. I think if the interest rates go up, then the caps are gonna go down.
No, the caps actually go up too.
Okay.
Yeah, good, good. I love the initiative, Betsy.
I'll give it a shot.
So what happens what happens to money when interest rates go up? Money becomes worth more or worth less?
Worth more.
It becomes worth more. So your client who's paying $500 a month into their IUL is still paying $500 a month. So now that $500 has a little bit more buying power to it, so we can buy more cap. Okay, that's important because interest rates have been historically low over the last couple of years. As interest rates go up, you're going to see caps go up. But also, what else is going to go up too?
Cost of
Inflation.
living, basically.
Inflation goes up.
Well, not necessarily. It's actually rising interest rates is a response to inflation.
Inflation.
Okay, they're trying to, by raising interest rates, they make money harder to get. Okay, so they bridle it back. Okay, that's in response to inflation. That'll curb inflation, but it makes money worth more. Okay, so it's harder to get. It's more expensive to get money, so you buy less house, right? But the caps, if you keep putting in $500 a month, the cap goes up, but that also the loan rate goes up. Okay, on these variable loan rates. If the loan rate gets so high, and we have a couple bad years and we get zero, the floor of 0.25, it could be a bad day for some of our clients. So we want to have a cap loan rate on the loan. So in the low rate environment right now, the money is cheap. It's more accessible. You can, it buys less cap. When I started in the business, the caps with F&G were like 18 and a half. They're all the way down to 13. Okay. When interest rates go up, money is going to be more expensive. So you're going to be able to buy more cap. But the thing I want you to get here is we got to have that cap loan rate. And I'm going to talk about that in a little bit. Okay. Any questions there? You guys all with me?
Yeah.
Cool. Okay. So we're going to talk how we protect our clients from unnecessary taxes. How do we get this sucker tax free? Okay. The loan provision. Who wants to talk about how the loan works? You want to tell me how the loan really works, where the money comes from?
So you're taking it from your, sorry, go ahead.
Go ahead. No,
Okay.
ladies first.
So you're taking it from the cash value that you have, and you're borrowing from that. And then if you pay yourself back, it's just going right back in there too.
That's not what happens.
Yeah.
No?
Against your
That's not what
Bro,
happens.
you're using your cash value as a collateral to
Mhm.
get it from the general funds of the insurance company.
That is right. And I heard Cheryl say that too. Yes, Mohammed and Cheryl, you're correct. What we do is the client buys a death benefit. Make no mistake about it. They're buying that death benefit. At retirement, the client wants tax-free income. So let me ask you, who do I see up here? Go ahead, Shelley. Since you went out there, I want to get you and make sure you understand this. So let's say we have Jackson Insurance Agency and Shelley is looking at their client, Jeff Sigworth. Okay. If I have a $420,000 death benefit and I have $100,000 in cash value, would you, from your general coffers, Shelley, give me a loan for 20 grand?
Yes.
Why?
You've got 100,000 collateral.
Yeah. But what happens now? I take out a loan for 20 grand and I run into some moonshiners on the way home because I live in Western North Carolina. I run into some moonshiners and I don't make it home. Okay. And I don't make it home. What do Carissa and the kids get?
What?
What do Carissa and the kids get? My wife and kids
Oh,
get if
oh,
I don't make it home? They're going to take that 20 grand away from my death benefit.
Yep.
Right. Now,
Yeah,
what
right.
happens to my cash value?
To the
It
money
goes-
in your cash
goes-
value?
What happens to the money in my cash value?
Well, it depends if your cash value was still in the option B, then
No,
you'll
it does
get.
not.
No,
Nope.
the cash value goes back to the insurance company.
That is 400% right. Is that
Isn't that-
Betsy?
Yeah,
Was that
Betsy,
Betsy? Yeah.
Betsy.
In
Yeah.
every situation, unless if the death benefit and the cash value is the same, the beneficiary gets the death benefit. At no point does a beneficiary ever get the cash value. So when Forrester says, "Oh, we offer non-direct loan recognition," they're kind of padding their own pockets, right? Because that money isn't really yours. That money is going to go to them anyway. Okay, so we're borrowing against the death benefit, using that cash value as collateral. Now, when I get there, I want you guys to remind me, and this was a big aha moment for me. Okay, the cash value is what your house is worth. The surrender value is the equity you have in your home. And when you start taking loans out, it's exactly like a reverse mortgage. It's the exact same math. Okay,
You
and
say
once
that
you
one
kind
more
of
time,
think,
Jeff? Sorry, so the cash
the
value.
cash value is what your home is worth. The surrender value is the equity you have in your home. Okay, and when you start taking loans, that's like a reverse mortgage on your house. The math, the math is still the same. The concept there is the same. Okay.
Hey, Jeff, I have a question.
Yes.
Let's say, okay, you have this IUL plan, the face amount, let's say it's $500,000.
Okay.
And you already accrue about $100,000 in cash value. And at the time, it was on the B increasing side of your plan. You haven't gone to option A yet. No loan, and now the death benefit is $600,000. The face amount 500 and the additional cash value. If you pass away that year,
you get 500 grand.
Even though when it's on the B increasing,
you do not get the cash value. There's no situation where you get that. None. Zero.
I look at the cash value. I mean, yes, I don't know how the insurance company puts it on their books, but it goes back to them or it vanishes from you.
It goes back to them.
Yeah.
Yeah, I used to think that only works on the old form of whole life insurance where the cash value always goes back to the company. But if it's like the option B,
nope.
But you can see the death benefit increasing on the
death benefit increases based on the corridors. As the cash value increases, the death benefit increases. The cash value increases, the death. But it's not if you notice, it's not a apples to apples increase. So it's increasing. The death benefit's increasing. Cash value is increasing, but the cost of insurance is the delta, which is changing because your cost per thousand is changing. Okay. So it's not a complete apples to apples. So you get whatever that at that time you die and you go into your account and you see what that death benefit is. That's what your beneficiaries get.
Yeah, I know the death benefit, but I'm trying to understand this a little better. So it may not be exactly what's on the cash value, but your face amount, let's say it's $500,000. So now after, let's say 12 years, your death benefit is more than the face amount you initially took out. If you happen to pass away that year, what if the debt amount is more than the face amount originally? Wouldn't that be paid?
Oh yeah,
yeah, that's what.
You'll get the full amount, but you don't get the cash back. You get the increase, but you don't get the
okay. That's okay. Yeah. Okay. Was that
okay? So at
I'm
retirement,
still a little lost.
Okay, Shelly. So here's what I want you to think of, and I'll show an illustration or part of an illustration here in a second.
Yeah, do that. That would be good.
Well, I don't want to skip ahead.
Oh, okay.
The client gets tax-free income loans. Those are deducted from the death benefit. Sometimes there's so much interest being accrued to the account that it's not even. Okay. When you pass away, the cash value doesn't go. It accrues based on your index and what you get. It doesn't change. Your death benefit changes because you have a net death benefit because you borrowed against it. So my death benefit's 420 grand, I pull out 20 grand in a loan, I don't make it home, increase and the kids only get 400 grand.
Yeah.
You with me?
Gotcha. Yes,
My cash value continues to grow. Now it is direct. It's not non-direct loan recognition. They do recognize the loan, but the cash value is so high and those numbers are so big on that cash value that it supersedes the cost of the loan. So if the loan on, let's say just easy math, if I have a $20,000 loan out and I have 5%, it's cost me 5%. How much is that? It's $1,000. Okay. $1,000. It's costing me in a year to have that loan out. Now I have 100 grand and I'm getting 7.9% on it. 8%. So I'm getting 8. How much am I getting? $8,000. Take away the 1,000. I still made $7,000 that year, even with the loan out. That's why it's important to have a low loan rate and a high cap. Okay. But when you pass away, the beneficiary only gets the death benefit.
Yeah.
Okay. The insurance. So client buys a death benefit at retirement. The client says, hey, I want tax-free income. Loans aren't taxed in this country. The colonists dressed up as Native Americans in the Boston Harbor. They got pissed off because England started taxing our loans, and they took the tea and threw it in the Boston Harbor. That was the precipitating event for the Revolutionary War. Okay, you ain't taxing our loans. It's not gonna happen in this country. Okay, so the insurance company gives us a loan to the client, tax-free. It reduces their death benefit because remember, as a client, I already bought the death benefit. I'm paying for that death benefit. So I further reduce their obligation to me. And they know I'm going to pay it back because they have my cash. They have all my collateral right here. They got it right here. Here it is. Right? Got it right here. So of course they're going to give me a loan. They got the money. Okay. They're going to pay it. It's like the ultimate living benefit. Okay. And when does the client has to pay back the loan? So when does he or she pay it back? Pay it back when they die.
Okay. Jeff, can I
Yeah.
stop you right there?
Sure.
How can we, because I've got a huge death benefit. Let's just say we've got a large death benefit.
Mm-hmm.
And you know that the person that's going to be the beneficiary of that does not need that money and you need it now.
Mm-hmm.
How can we tap into that death benefit without cash value?
You can't because they don't have the collateral.
Okay.
Yeah.
You could sell the contract.
Yeah, okay.
You could sell it. If I got $1 million death benefit, would you buy it for 800 grand? Because I'm going to die at some point.
Yeah.
I'll buy it off you. Viatical, sure.
Yeah. See, you could do that. It's called life settlements. They're called life settlements.
Okay.
Yeah.
So
you do
I have
that
a-
though, don't you get taxed? Wouldn't you get taxed on that then?
Good question. I don't know. I don't know how life settlements work. I don't know. That's a great question. I think you might get taxed on that money. I don't know.
Because wouldn't you get taxed on it, even though, let's say you opened up an IUL and 10 years down the road, you said, I'm done with that. I don't like it. And you pull out all your money, you're going to get taxed on that.
If you pulled out all your money, anything above and beyond your cost basis, we're getting there right now.
Okay.
So who can tell me the difference between a loan
right.
and a withdrawal?
The loan, my understanding, you're borrowing against your cash value, and the withdrawal, and so the cash value doesn't reduce. But when you do a withdrawal, you're reducing the cash value.
Yes. So give me an example. And I use one that's kind of funny. Give me an example when you want to do a withdrawal.
I have
Give an example.
$100,000 in my cash value. I want to do a withdrawal of up to 80%. I made that withdrawal, whatever that amount would be. My principal amount is not depleted, so therefore it's still earning compounded interest. However, I was able to get my loan at whatever my variable interest rate is. I'm responsible for paying that interest annually. And I could collectively choose how to pay back that loan should I desire to pay it back, or it'll come out of the death benefit once I pass, providing I've been keeping up with the interest payments.
You're right, but what's the danger in that? Now, what's the danger in that, Bobby?
The danger in that is that you borrowed more than you probably should have. And when you need at retirement age, if you have not refunded that or paid back that loan, you'll have severely dampened what you're able to withdraw when you need it the most.
Right, and the biggest issue there is, let's say you took out a withdrawal for 80% and you got floor. Oh, thanks, buddy. Look what Mike brought me. I know.
That's
I know.
Christmas for you.
Step back. So when you
What a guy.
I
That's
know.
adorable.
So if you have that loan out, and let's say you get a floor 3 or 4 years in a row, and you're 75 years old, now you just overloan the policy. Okay. I like this idea. Okay. If I'm going to Mexico and I got to take care of something and I'm going to repay it back, I might do a withdrawal, because if I go to Mexico and don't come home, I'm going to keep the death benefit intact. That makes sense. Like if I got to go do something dangerous and you need to keep that death benefit intact and you plan to pay it back, okay, do a withdrawal. I would say 999 times out of 1,000, you're going to want to do a loan, and it's for retirement.
Yeah.
Okay.
Let me ask this question. Let's say I'm 40 years
Yeah.
old, and I
Okay.
have this plan for the last 15 years.
Mhm.
And I want to take a lump sum of money out for whatever reason. Let's say I want to do a house repair.
Mhm.
I do a loan, so I loan against it,
Mhm.
and then age 70, I'm ready to withdraw. Am I still
Well, you-
safe at age 70 to start
It, dep-
withdrawing?
it depends. Did you pay back your loan?
No,
How
I did
much?
not pay
How
it
much?
back.
Well, it depends how much you loan. If you have $200,000 of cash value and you took out 10 grand, probably no big deal, right? It'll affect it, but not severely. If you start taking 50, 60, 70% out, IULs are not great for infinite banking. Cost of insurance gets high, okay? And there's no guarantees, okay? That's why we don't use IULs for infinite banking, okay? I gotta hustle a little bit here. The loan directly affects the death benefit. A withdrawal may not affect the death benefit, but it is reflected in that cash value and surrender value. So now you're playing dangerously, because if you get floor 3 years in a row and you're of an age where that cost of insurance eats up the cash value, you could overloan the policy and you could surrender the policy, which means taxes would be due immediately. Both are tax-free as long as that withdrawal is below the cost basis and the policy stays in force. Okay. Now here's where we're going to get into some cool stuff. This is my IUL, so I know it pretty well. Okay. So we're going to talk about the net dollars at risk and the cost of insurance. Okay. So right here, what's the difference between these two numbers?
I'm just about 134, somewhere around there.
Yeah, 134. That 134,000 is what you're paying on the cost of insurance. That is what's called the net dollars at risk. So even though at this point I'm 68 years old, I'm only paying, my cost per thousand is higher, but I'm not paying for this whole death benefit, because if I die, this goes to the insurance company, or this goes to Creasa and the kids. This goes to the insurance company. So I only, the dollars at risk for F&G is only $134,000. That's the delta, or the gap that they have to fill. Does that make sense? Okay. Now, so you take the net dollars is the death benefit minus the cash value. What is the net dollars at risk right here? Go ahead, Betsy.
Yeah, like just barely over 1,000.
Yeah, $1,100. So even though I'm 69, 70 years old here, cost of insurance is much higher. but
Mhm.
I'm only paying on $1,100. So if you don't set up an IUL properly, you don't get into this situation. The earlier you get into this situation, the
The better.
cheaper it is for the client, the better. Yeah. Now look what happens here. What
Now
happens in this
there's
year?
no net dollars at risk for the insurance company.
Cost of insurance is zero,
Yeah.
goes away. That's where Dave Ramsey is completely wrong, and Dave Ramsey won't get on the phone or get on stage with me because what he says about IULs, how the cost of insurance increases in perpetuity, and it's just flat wrong if they're set up correctly. So this is why I'm such a stickler for setting up IULs correctly, because the sooner you get into this state, it's the best thing for the client because now they're not paying for that cost of insurance.
Yeah. Hey,
So-
Okay.
Jeff. Hey,
Yeah.
Jeff, quick question. So
Yep.
even though when you run the illustration, you did it, let's say, to level up at age 65, when the year they start paying premium,
Yep. Mhm.
you gotta let the client know, they need to call the company to change that, right? Because
Yep,
even
you
though you
have to-
submitted the
yes.
illustration that way, the client, because let's say you're no longer around at that time and the stuff is still increasing, the company doesn't just go ahead and.
They don't.
They
But
don't. Okay.
because of the popularity of IULs, insurance companies are getting a little bit more user friendly, and they realize that's why you have to put a signed illustration in with because the insurance companies realize they're going to have to coach them a little bit.
Okay.
Now, remember what I told you guys. This is what your home is worth. This is the equity you have in your home. Okay. So I'm at this point, you can see I'm taking loans out. Okay. The value of my house keeps going up, but my equity is depreciating. It's going the other way because I'm taking loans against it. And my death benefit's going down. Okay. That was huge for me when I got that. Okay.
Okay,
Somebody just had an aha moment.
I did.
that if you think of it in that way, it's huge. So
Yeah,
Betsy's math was right. 134, 467 net dollars at risk. The life insurance only has to cover me if these are my numbers. And I only have to pay for $134,000 of insurance at that point. This year, I only got to pay for $1,100. It's nothing. All that money is going into the cash value. Okay. I don't have to cover the cost of insurance. I'm taking loans, so I'm not paying anything in. And now it just keeps going the other direction.
So I have a
Okay.
question. Even though the cost of insurance goes up as you get older, but you're paying less insurance over time as that gap closes.
Yep.
Okay.
And I'm gonna give you this too, because this is the end. This is basically the end. Now let me ask you guys this, so you guys understand this. Okay. So in year one, the insurance company has all the risk. When you start taking loans in the first year that the net death benefit, because the death benefit's there, but this is the net death benefit, because I have loans out, so they're only going to pay me this. The first year that the cash value supersedes the net death benefit, cost of insurance goes to zero. And let me ask you guys this on cash value life insurance. I get possibly another adult beverage here if you guys get this right. Okay. Somebody's paying $1,000 a month into an IUL, and they get rated table 4. What does the price change to?
The $1,000 is still the same. It's just the cost of insurance that's gone up.
And come on, Mohammed, you're right. Come on, dude.
Well, because they got rated.
Okay. Oh, dude, you're like 93% there. You're right. Cost per $1,000 still stays the same. The cost per thousand, cost of insurance goes up, but on what? On less death benefit.
Unless that, yes.
Unless death benefit. So
Yeah.
the cash value that spits out the back end doesn't change much. It does a little bit, but it doesn't change much because we're paying more per thousand, but on less insurance. So it's kind of a net wash. Okay. I owe you a beer sometime, buddy.
Yeah, but too bad I don't drink.
I owe you a soda. I owe you a Diet Coke.
There's a Diet Coke. Mhm.
Okay.
That's the bar agency. Most of us.
yeah, we don't drink.
We don't drink.
So
Out of it.
That's ironic right there.
so that's That's how it works a little bit, guys. That's how we're able to, protect their family, protect their income. We're able to protect them from market risk with that cap and floor, the volatility, control index. That's how we protect it from taxes, getting those loans out, borrowing against the death benefit, using that cash value as collateral, the money coming directly from the insurance company. We talked about withdrawals and loans, how it may, depending on your client situation, 90% of the time you're going to want to do a loan, but there could be a situation where you would want to keep the death benefit in force and do a withdrawal. And then we talked about how the insurance company really makes money because they want you to live forever. My father-in-law says, I don't know about life insurance. You're betting on yourself dying. No, you're not. They want you to live forever. The insurance company wants you to live forever. Okay, because they get more money. That's how they're making money. You're taking loans, they don't pay out the death benefit, as much of the death benefit as you originally had because you took it in loans. So you're getting it anyway. And then that cash value continues to grow forever, and that goes back to the insurance. Okay. So that's how they protect you from outliving. That's how we protect you from taxes. That's how we protect you from market risk. And it comes with the death benefit if you die early. So that's really kind of what's going on behind the curtains. You guys, that makes sense to everybody?
Yeah.
So I have a question.
Yes, Shelley.
So as far as, I know it's a lot the same, the IUL and the debt-free life. So does it kind of work the same way in the debt-free life policy as far as that goes?
It works differently. That's where it's different. So the things with Par Whole Life, they're the same as the IUL is, well, they're different because of the guarantees. We get the pit. I'm going to be textbook here. I'm going to tell you. I'm going to give you a textbook, and I'm going to give you the Jeff Sigworth answer. Okay. The textbook is in an IUL and in a Par Whole Life, you get to pick how much overfunding you do, right? You get to pick a percentage of PUA.
Okay.
You're going to pick 65% of the PUA. Can you set up an IUL like that? Yeah, you can, but I'm not going to let you. I'm not even going to show you how to do it. Okay. Because that does a disservice for the client because there aren't guarantees in there. Money goes to insurance company. Okay. Both of them put it in bonds. What a participating whole life does is just, hey, I'm going to give you those bond proceeds and some profits from my company. Guarantees plus dividends. Right? What an IUL does is they take those bond proceeds, they take that money and they buy an options budget. That's what gives you the increased interest. That's why you see higher interest rates in an IUL. All things even, an IUL over the course of 5, 7, 10 years is going to kick the snot out of the interest rate in a participating whole life, but it's not guaranteed. Okay. So when I said from day one, we started this, day one, I said the only reason you get somebody in to an IUL is for
retirement.
Tax-free retirement. It has nothing to do with death benefit. It has nothing to do with infinite banking. Steve, I owe you a soda pop. It's for tax-free retirement. That's it. If somebody wants a death benefit, go get a cheaper death benefit somebody. If you want to do infinite banking, go to a participating whole life. An IUL's sole purpose is tax-free retirement. Done. Okay. Any other questions?
What if you have an investor?
Damn.
What if you have an investor that wants to leverage the cash value to acquire real estate? Why would an IUL not serve that purpose?
So are they gonna just use it as an asset, or are they gonna actually borrow against it?
Gonna borrow against it.
You have potential to overloan it. So how much is the property? How much is in their cash value? How old are they?
If you're looking for aggressive accumulation that the cash value affords in a manner that you wouldn't get in a whole life, it's purely for that reason. Now, they could probably, depending upon what the loan is that the insurance company is going to give them versus the loan that they're going to get in the bank, they can use that cash value as leverage. So in that scenario, it seemed like,
yeah, they can.
Okay.
They can, but I would highly advise against that. And the reason being is, what happens if that individual doesn't pay the loan back? What if they're 70 years old and we have 3 years of floor? Now, all of a sudden that thing lapses and now taxes are due on the whole damn thing. Because we don't have the guarantees like we do in a par whole life. Okay, that could be a dangerous play. That could be a dangerous play. Now, if you have $900,000 of cash value and you want to buy a $50,000 car, I don't think it's a big deal. But when we start talking about loaning 60, 70, 80, 90% of that, I would caution against that, especially with somebody that's over 55, 60. Could be a very bad day for that person.
Right. I mean, if this client had a couple of policies and combined cash value is such that you only, leverage, let's say, a third of it to avoid that issue.
Yeah.
We're not talking more than 50% of it. I'm talking like
I
a
think that's
third.
fine.
Okay.
Yeah, I think that's okay. And
Right.
with some, they would have, I would tell that client, you're going to want to pay this back.
Right.
If you don't, the older you get, the more at risk, the years you hold on to this, the more at risk it could be.
Yeah,
Got it.
that makes sense. Especially if it's a real estate investor, they're probably using the money to buy a property, fix it, flip it, and put that money back in the plan so they can continue using that way. Yeah.
That would be great, but I'm telling you guys, 2008 wasn't that long ago. I got laid off twice in the same year. My job didn't exist, and real estate is still a market.
Yeah. Yeah, that's true.
Do you have a presentation slide to do in IUL?
I do actually. Maybe next week we'll go over that presentation slide, and I'll do kids policies. I'll show you what I did with my daughter. I've personal experience in this. I have a son, and I say he's a stepson, but I've known him since he was 3, and if he screws up, I got to pay for him, so he's mine. But we did a 529 plan for Parker and saw it go like this, and I got nervous, so I started putting money into an IUL for Noelle, my daughter, and I'll show you guys that in the presentation slide. Remind me next week.
Yeah, that would be great. Thank you.
Yeah, I think a presentation, even a mock appointment or something would be very, very helpful without taking away from your planned curriculum, Jeff.
Yeah, we can do that. We can absolutely do that. I keep the slides kind of generic, so you can change them and customize them for your clients. I just keep them generic. So I'll show you guys the generic slides, and then we'll talk about how to set up kids.
May I ask a question about the infinite banking? You mentioned that's
Sure.
obviously a hot term. It's sexy.
Sure.
People love what they can do with it. You are very adamant in your statement that if you want infinite banking, go participate in whole life. Can you talk about that a little bit versus IUL and why IUL is inappropriate for that?
Yeah, here. Let me see if I can bring this up real quick.
Jeff, this has been super helpful. I have an appointment, so I gotta peace out, but thank you so much. And I'm really-
Awesome. See ya.
Peace out,
See you later,
Betsy.
Betsy.
See ya. So can you guys see my screen?
Yeah.
Look at the cash value here. This is an IUL that I did for me based on the DFL report that we're certifying everybody. Look at the cash value here. This is the Barclays index, 35.7, 46.7. Okay. This is non-guaranteed. The middle column, 35.46. Look at this column, 36.46. Right? It's the same, and it's actually more than the middle column, 4.75, which we could fix. And if you look really closely, it goes down to 71 here in the 4th year. And we're only above in the IUL, possibly in the 4th year. Okay. So what's part of the thing that we really want to do with infinite banking and with DFL? We want to change their habits. We want to get them success right away. We don't want them to sit there for 4 or 5 years until they have traction. We want to see this thing make an impact right away. So yeah, in 20 years, right? The IUL is $495,000. The par whole life's only $345, $150,000 difference. Okay. But in the beginning here, I really should put these on the same screen. In the beginning here, it's the same, or the par whole life outpaces it. Okay, because of those robust guarantees. Okay.
So to simplify, go ahead.
Go ahead. Yeah.
Because I'm slow, I can't keep it all. So in essence, the IUL, based on illustrations, of course, but the IUL will outperform participating whole life over time. However, the participating whole life gives more immediate results. So you can start using that banking concept immediately, as opposed to looking at your watch for 7-8 years.
Yeah, and we don't know what their debts are, right? Most of the time it's going to be there, but we want to be darn sure it's there. It's kind of like when you're at a stoplight and the bike beats you off the line. You're like, how the heck did that guy in a cycle, cycling beat me off the line? You got to race halfway through the intersection to catch up with them. That's kind of like the difference between an IUL and a par whole life.
So someone who's fresh out of college, and let's say the only debt they have maybe is their student loan, would it be best for them to do a participating whole life to get that student loan out of the way? Or
I would do two things if they have the money to do it. I would set up an infinite banking policy, and I would set up a tax-free retirement policy. That's what I would do. There's a reason I have a pickup truck, and there's a reason I have a diesel sedan. I have a pickup truck because I have a bunch of, probably can see it out the window. I have a bunch of brush in the back that I ripped up some bushes this weekend. And then I have a diesel sedan because I get 45 miles a gallon, right? You have different cars and different policies for different tasks and different purposes. All right, guys. Appreciate it. We're on for next week, Mark. Take it out another week.
It's the final week. Thank you so much. This has been
You got it, guys. You got
another good week. Thank you.
Def looking forward to that presentation.
it. All right.
Thank
Sounds
you,
good.
Jeff.
I'll
Okay,
see you guys
have a
soon.
great day.
All right, you too. Bye,
If you have
guys.
any questions,
Reach out if you need it.
Thank you so much, Jeff. Take care. And guys, just so you know, Jeff is a powerful resource. He is, head of Quility Advanced Markets. So I'm not suggesting we barrage him with questions that we can, learn ourselves from the carrier or otherwise. However, Dominic, I want to applaud you. Dominic's wife, Holly Austin, is an educator. She's a teacher, and she reached out to Jeff to strategize how she can best approach teachers at her school and beyond. And they're currently working together on that. He's happy to help. So I know, for instance, Mohammed, that was awesome. You were literally walking out of a building prospecting on last week's Newbauer Thursday meeting. And I just thought that was so awesome. And, if you ever want to pick his brain or, get some ideas, by all means, guys, he works for Quility. They work for us and vice versa. So I just want you to know his expertise is available company-wide. Be selective as to, what and when, and always talk to your direct first, because it might be something simpler than Jeff needs to be handling. That said, again, he's an amazing resource, and we're lucky to have him be so generous with his time. So thank you guys for being proactive and being on these calls. We are recording the series. I have them on private links right now because I'd like to put some bumpers on them, trim the fat if there is any. And then we'll have the whole 5-week series on our YouTube channel. Special thanks to Dustin Hensley, who's helping us keep track with that. He edited last week's and had it up before we even discussed it. So he's awesome. Thank you so much, Dustin. And I guess he's not on. I saw him in the chat room there. He's gone. But I'm sure we'll have week 4 up tomorrow. If for any reason you missed a week, you just want them before I get all 5 up and edited clean, I do have the private links for week 1 through 3. By tomorrow, we'll have 1 through 4, and you can just shoot me a text or send me a request and use that so that you can rewatch some of the things that maybe you didn't get a chance to take notes on. Awesome.
Thanks, Mark.
Great, guys. Yay, my pleasure. You guys have a great day, and we'll see you at the latest next week. If you're on the Team Newbauer, we have our Thursday meeting at 2:30 Eastern, the same link, and I'll see you guys there. All right, take care.
Hi, Mark. Thank you.
Thank you, Mark. Thank you.